Okay, thank you, ladies and gentlemen. First of all, allow me to invite the Honorable Mr. Indra Pahala, Vice Dean of Students Affairs of Faculty of Economics, Universitas Negeri Jakarta, to deliver the opening remarks. Mr. Indra Pahala, have you joined us?
Yes.
Okay, the floor is yours.
Okay, thank you. Dear distinguished speaker, Professor Raghavendra Rao, dear participants, students, academics, and practitioners, good afternoon. Assalamualaikum warahmatullahi wabarakatuh. First of all, I would like to thank each one of you for joining this international seminar. I bid a very warm welcome to the prominent speaker, Professor Raghavendra Rao, and participants who took out your valuable time and join us today to be a part of this seminar. We are honored to have you all with us. I would also like to thank Faculty of Economic and Business, Brawijaya University, Faculty of Business Widya Mandala Catholic University Surabaya, the Indonesia Financial Management Association, and PT Samuel Asset Management for co-organizing and supporting this wonderful seminar. Ladies and gentlemen, this lecture is organized in order to celebrate the 17th anniversary of Faculty of Economic State University of Jakarta. We organize many events to celebrate this year anniversary, such as International Stock Portfolio Analysis Competition, International Marketing Competition, Accounting Competition, the Office Explorer Competition, e-sport competition, fun walk, donation for the poor and orphan, and of course this international seminar. The title of the seminar is Are Women Undervalued? Both Gender Diversity and IPO Underpricing. I wish this seminar enlightens us all and provide us with approach to deal with the problem in finance. Last, I ensure this seminar will fruitful for everyone present here. Please enjoy it. Thank you very much.
Well, thank you very much, Mr. Indra Pahala, for your warm welcome. Now, ladies and gentlemen, before the presentation, the main session begins, let me inform you the rundown of the seminar. First, I will invite the moderator today to give a brief introduction for the prominent speaker, and after that, the main session presentation will be held for the 60 minutes, and after that there will be a question and answer session for 30 minutes, and followed by the conclusions. So now I will invite the moderator today, Mrs. Silvana Shah. Mrs. Silvana Shah, have you joined us?
Yes.
Okay, Mrs. Silvana Shah, I will give introduction first. Mrs. Silvana Shah is the doctoral candidate of the State Universitas Negeri Jakarta. So, Mrs. Silvana Shah, are you ready to moderating the seminar?
Okay, thank you, Miss, for the brief explanation.
Okay. The floor is yours.
Yes, thank you. Thank you, Miss, for the brief explanation and also for opening this webinar. Good afternoon, ladies and gentlemen. A very warm welcome to the International Seminar Series Economics Expo 2022. And the topic for today is about Are Women Undervalued? For Gender Diversity and IPO Underpricing. My name is Silvana Shah, and I will be a moderator for the next 2 hours. Well, ladies and gentlemen, I would like to greet the Honorable Vice Dean of Student Affairs, Faculty of Economics, Universitas Negeri Jakarta, Mr. Dr. Indra Pahala, the Honorable Chief Organizer of this seminar, Mrs. Dr. Bumi Widyastuti, the Honorable Head of Management Study Program, Faculty of Economics, Universitas Negeri Jakarta, Mr. Dr. Suherman, the distinguished speaker, Professor Raghavendra Rao from the University of Cambridge, the honorable participants of this seminar, students, academics, and practitioners. good afternoon in Indonesia, and good evening, Professor Rahul Pedro from San Francisco. How do you do? I hope you stay hot. Ladies and gentlemen, today we've got Professor Rahul Pedro from the University of Cambridge. Good evening, Professor. How are you?
I'm doing well, thank you.
I hope you. Yes. Okay, before we start, I'd like to read the curriculum vitae from Professor Rahul Pedro. Professor Rahul Pedro is Sir Evelyn de Rothschild Professor in Finance at Cambridge Business School. He is also a past president of the European Finance Association and a past editor of Financial Management. He is a founder and director of the Cambridge Center for Alternative Finance, CCAF, and a member of our Cambridge Corporate Governance Network, CCGN. Professor Rao has taught at a number of universities around the world, including the Institut d'études politiques de Paris, the University of California at Los Angeles, and most recently, the University of California at Berkeley. Professor Rao was a principal at Berkeley Global Investors GEM, the largest asset manager in the world, in San Francisco from 2008 to 2009. He is an associate editor of Journal Corporate Finance and Journal of Banking and Finance, Financial Review, and Quarterly Journal of Finance, among others. His research has frequently been covered by the popular press, including the New York Times, the Financial Times, the Wall Street Journal, and the Economics, among others. So many awards and honor that Professor Rao achieved. TMA Competitive Paper in Corporate Finance Award for the paper Due Compensation Consultants Enable Higher CEO Pay, New Evidence from Recent Disclosure Rule Changes 2015, IG Nobel Prize in Management for the paper What Doesn't Kill You Will Only Make You More Risk-Loving, Early Disaster and CEO Behavior 2015, and many others. Many of Professor Rao's papers are available via Social Science Research Network. Okay, the presenter will have 60 minutes for their presentation, and after that we have 30 minutes for a question and answer session, and we encourage you to ask questions and engage in discussion, and we will have a dedicated time for question and answer prior following the presentation, and at that point by raising your hand, and I will allow you to ask questions directly to the speakers. Now allow me to invite the prominent speaker, Professor Rahul Pedro, to deliver the presentation. Professor, have you joined us?
Thank you very much, yes.
Okay, Professor, you have 60 minutes, and I will remind you to expand your time will run out. So without further ado, now stage is yours.
Okay, thank you very much. Let me share my screen. Okay, so this paper is co-authored with two of my colleagues, Jason Sandwick, who is at Tulane, moving to University of Arizona, and Theo Mallon, who is at INSEAD. And the basic research question is very straightforward. Right? We know in the last few years, there's been a huge increase in demand for female representation on boards. But the question which I'm trying to answer in this paper is, what is the effect of that gender diversity on the board, that is the presence of females on the board, on the value of the firm? Now, there are two streams of thought over here. First stream of thought says, but diversity is actually good for performance. Right? There are a bunch of papers. For example, the paper by Google, who argues that it increases monitoring. The paper by Chen et al., who argues that it curbs overconfidence. Women are less overconfident than men. Coles has a paper where it says reduces groupthink. That means people don't think the same way, so there are less biases that way. But there's another group of papers that argues that performance improves diversity. So it's not that, if you have more women on your board, you do better. It is the better performing firms are more likely to put women on the board because they have more organizational slack. Right? They're making a lot of profits. They say, women don't really contribute very much. But still, let's have a woman on the board because you can afford to have a woman on the board. The direction of causality is not obvious. Is it diversity improves performance or performance improves diversity? There are a whole bunch of papers which have actually looked at exogenous changes in board composition. So, for example, in Norway, the Norwegian government said that 40% of the board needs to be female. But those have their own problems, and I'll talk about some problems later. But for now, let me talk first about that increase in demand for gender diversity. Back in 2020, January 2020, Goldman Sachs announced that it would no longer underwrite the IPOs of companies with only white male board members. So this was the newspaper article, which was published in January 2020. And they said, the interesting part was the Goldman Sachs CEO, David Solomon, said, I'm only going to take public any companies where there's at least one non-white male board member. And he said, it's a small step, but it's a direction of saying, we know what, we think this is right, we think it's the right advice. And he said, there's significant financial incentive for companies to diversify the board. And he says, over the last 4 years, the performance of IPOs, where there's been a woman on the board in the US, is significantly better from the performance of IPOs, where there has not been a woman on the board. So they're saying, economically, it makes sense to have a woman on the board. And this particular decision cost Goldman quite a lot. For example, there was a study around January 28 of 2020 from Bloomberg Law, who basically said if Goldman had done this plan over the previous year, they would have lost $101 million in fees because, all these companies that took public, they wouldn't have been able to take public. In addition, in the same month, NASDAQ announced they would require at least 2 what they call diverse directors. What's a diverse director? It's one person who self-identifies as female, one who self-identifies a minority group member or LGBTQ+, or explain why they couldn't satisfy these requirements. So in other words, if you're listed on NASDAQ, if you're going public using Goldman, you have to have a woman on your board. Now, so what do we do in this paper? We look at that process of going public using an initial public offering, right? So what we are saying is, if you have a woman on your board, how does it change the level of underpricing of the initial public offering? And how to define underpricing is this is the percentage change in the price of a share on the issue date of the IPO from the offer price set by the investment bank to the closing price at the end of the first day. Okay, so why does this matter? Why do we care about this topic? Well, the good news is, if you're looking at IPOs in particular, the process of building the book on the IPO, that means the process of talking to, institutional investors and other types of investors and saying, how much do you think this firm is worth? That gives a unique opportunity for some investors, at least, to give feedback on that valuation range proposed by the investment bank. For example, if I'm an institutional investor, I might value gender diversity, but the investment bank doesn't know that I'm valuing gender diversity. So the investors in the book building process can show the value forms differently from the valuation proposed by the investment bank. For example, they might say, diversity increases performance. So I think my cash flows are going to be larger. Or they can say, I can use a lower discount rate for valuing gender diverse board firms. This is communicating new information to the investment bank. More interesting is that the IPO underpricing itself is unlikely to be subject to endogeneity. What does that mean? Well, remember what we said. We said that it could be that gender diversity causes performance, but it could also be the performance causes gender diversity. So this to apply in our scenario here, it would have to be that gender diversity causes underpricing or underpricing causes gender diversity. But that's not going to happen with an underpricing case. Why not? Well, if I'm going public and I'd say, I don't want to be underpriced. By being underpriced, I'm leaving money on the table. Nobody wants to leave money on the table. So in other words, if I hire a female director and I say, hey, come and join my firm, it's not because I think, my firm is going to be underpriced. The female director says, why would I join a firm that's likely to be underpriced? So the endogeneity doesn't exist here. It's that if there's underpricing, it's caused by gender diversity, but underpricing will not cause gender diversity. That's the two sides of the picture. One side is not going to happen here. So why might board gender diversity be related to IPO underpricing? Let's look at the theory over here. One goes back all the way to Ben and Spence, the classic paper in 1989. And the idea is, you have an IPO, you want to get information from the institutional investors about how much they value the shares of the firm, but they're not going to tell you, right? Because they have to pay that money in order to buy the shares of the firm. They want to make that value low, so they won't reveal their private information to you. So to persuade them to reveal the private information to you, you commit to underpricing the shares. You say, you know what, tell me the truth and I'll give you the shares at a discount. So here the private information, the Ben and Spence model is all about the private information on cash flow. We are arguing this private information on gender diversity. So the other possibility is that investment banks don't know how to price gender diversity. For example, maybe they assume that gender diversity is not correlated with future cash flows. Maybe they ignore the possibilities that those preferences for diversity lowers the cost of capital. So when you use multiple to price the IPO, you're using a comparable company that's not really comparable. Maybe it's comparable in terms of industry, maybe it's comparable in terms of growth rates, everything else, but it's not comparable in terms of gender diversity. If you don't believe that gender diversity is actually important, you're using the wrong comparable. In either case, if that investor's positive demand for gender diversity is not there in the offer price, underpricing will be bigger for diverse board IPOs. That is exactly what we find. So what does the literature say on gender diversity? Well, there's one group of papers that argues that there's a negative relationship between gender diversity and firm value. Right? So classic paper by Adams and Ferreira, who say that, well, if you have female directors on the board, they have better attendance records than male directors. The average effect of gender diversity on firm performance is negative. Evgenio and Theo Malon have a second paper which points out that long-term excess returns following buyback are smaller when there's greater female representation on the board. And there's a paper by Solon and Snellman who argue that firms that increase gender diversity in the board suffer a decrease in market value. However, there's another group of papers which argue the exact opposite. For example, Kim and Stark say, well, female directors contribute unique skills that the male counterparts don't possess. This potentially can improve firm value. Kate and Yang say, well, you have female leaders, the more female-friendly corporation within the firm, that increases the value. Maria Sunta, Giannetti, and Wang point out that greater public attention to gender equality leads to increased recruitment of highly qualified female directors. And so lots of papers arguing for a positive relationship between gender diversity and firm value. And finally, you have a bunch of papers that say you don't know what the effect is of gender diversity on firm value. For example, this paper by Bonile, Bhagwat, and Yonker point out that gender diversity reduces risk, but if you reduce the risk, you also reduce returns. So it's unclear how that relationship between risk and return plays into the value of the firm. Cash flows go down as well as the discount rate. So overall, we don't know what the effect of firm value is going to be. Okay, what about mandatory diversity initiatives? This was all voluntary diversity initiative. Mandatory is the government tells you that you have to put in a diversity initiative on your board. For example, in California, Senate Bill 826 said that all publicly traded companies headquartered in California should have at least one woman on their board. What happened? Well, there's a paper by Green, Inintoli, and Kathleen Kale who points out significant negative announcement returns to firms headquartered in California on the passage of the bill. So they said, well, this is evidence that you add a woman to your board, it decreases firm value. However, another paper pointed out that, oh, wait a minute, this is not really true because it's only apparent among firms that retain the least favorable male director So it's not the female director that's reducing value, it's the fact that you didn't fire your worst male director. And of course, the entire thing has been completely invalidated less than 2 weeks ago. So on April 4, 2021, the judge basically threw out this rule mandating diversity on board. So, the California experiment, I don't know whether it's going to succeed or not. More important and famous example is in Norway, where the Norwegian government had a quota mandating that 40% of Norwegian firm directors should be women. Now, what did papers find? They found this was bad. For example, Ahn and Dittmar have a paper that showed that there's a significant drop in the stock price announcement of the law, large decline in Tobin's Q over the following years. Why? Because the boards were younger, less experienced, the increase in leverage and acquisition reduced operating performance. And Matza and Miller showed that firms in Norway undertook fewer workforce reductions, they increased the labor cost and employment levels, reduced short-term profits. This is all bad. But recently, there's a paper by Ekbo, Nygaard, and Thorburn who say that these quota studies are all wrong. Why? Because there's so much public debate that happens when a quota is imposed that it's impossible to find out the exact date at which this quota was actually became new information. Second thing, because you have a lot of shocks occurring all the sample forms simultaneously in calendar time, you got some economic factors that are driving contemporaneous positive return correlations across all securities. If you don't take that into account, it will look like you have a negative effect, but there's really absolutely no negative effect at all. Right? I think someone just had their hand up. I'm happy to take questions on the spot as well, if you prefer to ask me the question right now. Okay. Well, I'm happy to be interrupted in the middle as well. You don't have to wait all the way to the end in order to ask questions. Right. Okay. So what does the practitioner literature say? Well, the practitioner literature is uniform. Let's say gender diversity is good. It increases firm value. So here's a whole bunch of papers. For example, here's a paper by McKinsey who basically argue that gender diversity, great. Increase women on your board. It really increases firm value. The problem with these papers is there's no causation. It's just correlation between diversity and various measures of past performance. So what are the problems? Number one, endogeneity. Maybe it's all driven by some omitted variable. Number two, reverse causality. A good firm tends to put more women on the boards. And finally, survivorship bias. They look at firms in the end of the period rather than firms that began the period and went bankrupt through the period. They don't look at that at all. So I'm kind of, the practitioner studies don't actually tell you very much. So I'm going to ignore all of them. All right, where does our data come from? Well, our data basically comes from Kenny Patton's Emerging Growth IPOs, which is 18 years of data from 2000 to 2008, 18. We have information on all the directors. We don't have any mutual funds, real estate investment trusts, blank check companies, things like that. We can identify the director gender, age, and skill sets, and identify who the CEO is. So we have all this information. We merge with Thomson One to identify underwriters and other IPO details. We get data from Jay Ritter's website on the firm age, VC dummy, tech dummy, internet dummy, and things like that. And finally, merge with CompuStat and CRISP to get financial and stock return data. Eventually, our final sample consists of 1,112 unique IPOs issue dates between 2000 to 2018. So that's our database. All right, so let's look at what the data tells us. So on the extreme left-hand side, top here, you have the number of IPOs. Then this is gender diversity of IPOs on the board over time. It's institutional ownership of IPOs, and finally the size of the IPO. Let's look at each of this. If you look at the number of IPOs, what you can see right away is dot-com bubble. Huge number of IPOs in the year 2000. You can also see the Great Recession, when all the IPOs pretty much dried out. But what's also interesting is the Great Recession is also the period of least gender diversity. And it's also the period when institutional ownership started increasing quite dramatically. Right? And of course, the size of the IPOs have gone up significantly over time. But let's focus on these three things. Points in time when IPOs dried up and started increasing again, gender diversity increased, institutional ownership is going to increase. I'm going to relate gender diversity to institutional ownership and relate underpricing. All right, let's start by looking at all the IPOs, gender diverse, non-gender diverse over time. The first thing you see is that if you look at the IPO characteristics, there's no difference in underpricing with gender diverse and non-gender diverse. The p-value is 6.6, right? Gender diverse firms are more likely to have a top-tier lead underwriter, right? And they are more likely to be central underwriters, and lead underwriters are likely to be central in the network. I'll talk about centrality in a bit. Apart from that, nothing else is really important. The pre-IPO price change, the offer price, market price return, none of it is really significant. That's the IPO characteristics. Firm characteristics, pretty similar in size. Gender diverse boards, non-gender diverse boards, very similar on assets. Sales are actually a little lower for gender diverse firms. Everything else is pretty much the same. They're more likely to have VCs running gender diverse firms, but everything else is pretty much institutional, is pretty much straightforward. Looking at operating performance, what you have is profitability is a little worse for gender diverse firms, but their growth opportunities are a little higher, right? Other factors are pretty similar. So debt, liquidity, pretty similar. Of course, last bit is your corporate social responsibility, slightly higher for gender diverse boards and non-gender diverse boards. So this is the broad picture. Finally, let's look at director characteristics. What we find is gender diverse, non-gender diverse are pretty similar in terms of average director age, about 52 years. Director skills are a little higher for gender diverse boards, but this is the overall board, not the women on the board. They are also more qualified in terms of average director bio length. In terms of all the features, gender diverse boards seem to have just better boards in some way. Okay, so now this was the univariate statistics. Let's put it together in a regression. What regression do we use? Well, the first one is just very simple. Under diversity is a function of diversity on the board, that is a dummy variable. 1 if there's a woman on the board, and 0 if there's no woman on the board. Bunch of controls, year fixed effects, industry fixed effects. Okay? And I'm going to show you that this is a new pattern which happened after 2008. So I'm going to show you how the underpricing effect had changed over time. We're using the same thing, but now I have diverse into post, where post is after 2008, 2009. All right, let's take a look at this. First thing is a massive regression. I have literally dumped in here every factor you can think of from the first descriptive statistics you can take and saying, what is it that I'm controlling for everything, including year fixed effects, including industry fixed effects, lead underwriter fixed effects, year into industry fixed effects, year into underwriter fixed effects, everything you can think of, we have dumped in here. Let me zoom in on the important factors of this table. If you zoom in on the first line of this table, what she shows is after you control for everything you can think of, all these controls, size, performance, IPO characteristics, VC dummy, you name it, control for it. Turns out diverse boards have significantly higher underpricing in every regression we have. All right. But if there's one woman on the board, what about more women on the board? So the second thing we looked at is the fraction female. I mean, what's the percentage of women you have on your board? So that's even more significant. Again, controlling for everything else that you can think of. The first fraction female on your board, the higher the first year underpricing. How much money do you leave on the table? So this is number of shares times the difference in price from offer price to closing price. That's a standard measure in the literature. I'll talk about it in a little bit. So we find if you're a diverse board, you leave more money on the table than a non-diverse board. Again, controlling for every factor you can think of. Fine. What about the IPO process itself? Is it maybe that the process of going public is different from a gender diverse board or a non-gender diverse board? The answer is no. If you look at the initial filing price, right, that's a price at which the investment bank sets the price range. It's not different. It doesn't matter whether you're gender diverse or non-gender diverse board. The price, initial file price, midpoint stays the same. What about the percentage price change from file to offer? No difference. Diverse boards are completely the same as non-diverse boards. What about the final offer price in the date of the IPO? Absolutely no difference. The diverse board doesn't matter what the final offer price is. So now let me give you the major results of the paper in one graph. Before 2008, 2009, what I'm showing you here is, this is for gender diverse firms, the line here. And you notice level of underpricing is pretty within this 95% confidence level, they're pretty much the same. Something happened after 2008, 2009, and you notice the gender diverse boards have significantly different underpricing from non-gender diverse boards. It suddenly splits apart after 2008, 2009, right? So what is going on in 2008, 2009? Well, first thing is, if you look at structural break test, that's the break date. We saw that graph where we showed what's the IPO board gender diversity. It was the least in 2008, 2009, and then it started increasing dramatically. And in 2010, the SEC's required public companies to disclose the role the diversity considerations played when they selected directors. And lots of pension funds wrote letters in support of that regulation. A few companies, IPOs that did not initially include women on the boards, Facebook and Twitter, went public, and people criticized them like crazy because they said, there are no women on the board. How can you do this for such a big company? So what we do in our paper is we look at the IPO performance from firms going public between 2000 and 2009 to going public in 2010, 2018. Right? Now, this is what you can see. 2000, 2009 is the average fraction gender diverse on your board, less than 35%. After that, for the 45% of the 2000, 2018 have at least one gender diverse person on the, or basically boards or at least one woman on your board after 2000. A dramatic shift between these two periods. More important, our results are completely robust. Using 2006, 2007, 2008, 2009, 2010, doesn't matter. Use any of those things, our results stay the same. There's no difference in our results. So it's not 2009 special. It's that period of time, 2006 to 2011, that something changed in that period. All right. So now I'm going to break it up, 2000, 2009, 2000, 2010. Remember that overall, there was no difference in underpricing between gender diverse and non-gender diverse firms. But that is entirely driven by the 2009 period. There's no difference in underpricing here. The 2010-2018 period, highly significant. The under average underpricing is 25% for a diverse firm, 18% for a non-diverse firm. Right? There's a huge difference here, almost no difference here. Another thing which is interesting is before, institutions did not own gender diverse firms. Afterwards, a significantly higher proportion hold gender diverse firms. There are also, the book runners are the top people in their fields, right? So you have Goldman Sachs, Salomon Brothers, people like that. So more significant in that period, approximately the same in the 2009-2000 period. Okay. Okay, what else should we see? Well, firm characteristics, pretty similar, the sizes. We notice the assets are the same. Here we see the sales are still lower, exactly the same as before. Firm age is approximately the same. More likely to be held by venture capitalists, not more likely to be the internet, not more likely to be tech firms. This is important because one of the standard questions is, maybe it's all tech firms. Right? It isn't. There's no difference between gender diverse and non-gender diverse firms for tech firms. So what about profitability, growth opportunities and all that? Same things as last time. Operating ROI is worse for the diverse firm, but the growth opportunities are higher. Right? Other than that, everything else is the same, except for corporate social responsibility, which is usually higher for diverse firm for a non-diverse firm. Anyway, putting all this into perspective, the last thing we look at is what about the differential proxies for accumulated experience. Right? So this is what the age ratio is between 2000 and 2009. 0.93. That means the average woman was much younger than the average man. By 2009, 2010, 2018, pretty much the same. The bio length was about the same, and now women are getting better qualified. Number of skills was much higher in 2000, 2009. Now it's approximately the same. Okay, now let's put them all. So what we have here is, first one is the same, all the factors we talked about earlier. And we have over here diversity, right? So again, same thing as before. More diverse firms you have, you notice that it's significantly positive related to underpricing. But everything is happening in 2010, 2018. Nothing is happening from 2000 to 2009. There's no relationship here. It's all showing up in 2010, 2018. Another way to look at it, diversity to post, that interaction term, highly significant across all years. You can do the same thing for fraction female, significant across overall, but only because of 2010, 2018. And again, fraction female to post, significant in that period. Again, this is all the regressions we have. You see exactly the same thing, 2010, 2018, diversity to post in that period. Same thing with fraction female. It doesn't matter how you do it, you find the same results. Okay, will these guys leave more money on the table? Answer is yes. But again, after 2010, 2018, before 2000, 2009, they don't leave any extra money on the table. It's the same thing. After that, you notice the value goes up. How much does it go up? About $13.2 million more. And what happens is it's entirely driven by 2010, 2018, where you leave $26 million more on the table in that period than the former period. Okay, so why is this happening, right? Well, when it goes back to the question I asked you, are women undervalued? I mean, who is undervaluing women? One possibility is maybe it's investors who are undervaluing them. So we look at two types of investors, institutional investors and retail investors. What's an institutional investor? We look at guys who do block trades. So the number of block trades, the number of trades are 10,000 shares or more. And what we find is, if you look at diversity of block trades, notice that diversity is significant. Again, only in the 2010-2018 period. And again, diversity into block trades, highly significant. So it's even more significant if you look at diversity of block trades. And again, for all firms, you notice that diversity of block trades into post is significant and positive across the entire period, the triple interaction. If you look at the number of small trades, that's typically done by small traders, really nothing going on, right? So it's not small traders, it's entirely institutional investors who are driving this trade. Well, what about buys versus sells? Is it that they're buying more frequently, or is it they're doing a lot of trade, they're buying and selling? Well, here's buy volume. Notice that it's again, diversity to buy volume is significant in 2010-2018 period. In contrast, diversity to sell volume is not significant at all. So basically, it's not institutions selling, it's institutions buying. When you run a similar test using retail investor trading volume, what we find is the retail investors doesn't meaningfully impact the gender diversity underpricing effect. Right? It's all, again, driven, as I said, by institutions, not by retail investors. Now, another way of looking at institutional ownership is the percentage institutional ownership or the percent big three. Who are the big three? BlackRock, State Street, Vanguard. What we find is if you have a diverse firm, after 2010-2018, institutions are more likely to buy you. And BlackRock, State Street, and Vanguard are much more likely to buy you. So, okay, maybe these guys are buying their shares, but maybe they dump them after the IPO. So the underpricing is on day one, but then afterwards they sell all their shares. So initial underpricing is followed by long-term reversals. So what we do is we look at what happens, who are the institutional owners who are owning stock in these companies within a month of the issuance. What do you find? Well, if you 66% of the owners who own shares of gender diverse firm continue to own shares 1 month later. In contrast, only 61% of the owners on non-gender diverse board IPOs continue to own shares a year later, and that difference is significant at the 10% level. 2 years after the IPO, 47% of the institutional owners continue to hold gender diverse IPO shares. If you're non-gender diverse, only 40% continue to hold your shares, and that difference is significant at the 5% level. So these guys are not buying your shares at the IPO and then dumping them a month later or a year later. Okay, another way of looking at this is, do investment banks learn, right? So they learn about this is a hot IPO, investors are asking about this, so they revise their prices. Well, they do. That's exactly what you find. If you're looking at underpricing of IPOs, offer prices that are above the high price in the initial offer range, that's significantly greater. It's 50% underpricing among other IPOs where the IPO went public between the low and the high price or below the low price. So essentially, these guys misestimate the level of demand from institutional investors when they're revising their shares. So the big takeaway is simple. In the most recent decade, institutional investors have really wanted a huge number of gender diverse board forms. Banks have increased their prices in the book building process, but that has been enough to eliminate the excess demand. Okay, so the next question is, do the underwriters actually learn? Right? So the idea would be, if I'm doing a lot of IPOs, I'm really connected among all the IPOs, I learn. I look at other IPOs and I say, whoa, all these IPOs are being underpriced. I need to increase my shares. And I think it's because of women. So they learn. So how do you measure centrality? Well, we use a degree measure by Manuel Bajo and a couple of others. And so for each IPO, we take each underwriter of the deal, look back 5 years, and identify how many unique IPO underwriters exist in the sample. So say how many unique underwriters this guy is connected to by being part of the same syndicate. We call that number N. And the degree measure is just small n, the number of guys this underwriter is connected to, divided by the total number of all underwriters in the sample. That's the centrality measure. And the idea is, what's the largest degree among all the underwriters? And that's the IPO. If you've got 4 underwriters, one has a degree measure of 2, 3, 5, you take 5 as the biggest of the lot. That's called max degree. And we say, who are the guys with the median level of max degree? Who are the guys who are highly connected underwriters? Who are the guys with underwriters who are not connected? Well, what do we find? What we find is, if you look at diverse, right? Diverse in the post is significant, but again, on the low degree guys, not on the high degree guys. In fact, the high degree guys seem to learn. So when do they learn? Well, to understand that, we break it up into 2010, 2012, 13 to 15, 16 to 18. And what you find is, initially, reverse into that period, there's no difference between the high degree and the low degree people. This is insignificant. There's no difference between the high degree and the low degree people 2013 to 2015. 2016 to 2018, that's about the time when State Street, Vanguard, and BlackRock started publicizing how important gender diversity was to them. The diversity effect goes away for the highly connected underwriters. The sum of these two is insignificant. So basically, for the highly connected underwriters, they learn that gender diversity is important and they adjust the prices accordingly. Well, so why do institutions demand this higher number of shares? Like multiple reasons. One is, this is because there are cash flow consequences. I mean, there are only 2 ways where value can be created. One is increased cash flows. The other is a lower discount rate. Right? That's it. You've got cash flow divided by R, the discount rate. So it has to be one of the 2. So do cash flows go up? Well, there are a number of different people who argue that they do. For example, maybe they substitute for corporate governance, or maybe they are less overconfident than men, right? So you don't do overinvestment. There's no excessive risk taking. Maybe you're less susceptible to groupthink. All of these are direct cash flow consequences, right? Maybe diverse leadership sends a positive signal about the firm's ability to attract and retain a diverse talent pool of employees. So this is all good stuff. So what we do here is look at performance. So this is ROA, right? Diverse, again, diverse into posts. Notice that nothing is significant. In other words, in operating performance terms, they're exactly the same. Gender diverse boards is the same as a non-gender diverse board. Okay. Maybe another way of doing it is, okay, most boards, don't really do very much. Right? I mean, you pretty much, when the CEO says something, you approve it, right? I mean, the CEO, how much do you know what's going on? So the only time when a board is really important is when something big happens, like a merger, a tender offer, or something bad, like a scandal, a misrepresentation, something, a class action lawsuit. So maybe the women only act then. They're very good about acting when bad stuff happens. This won't be picked up in operating performance, but it will be picked up in, it will be picked up in market value, because that's where the value of the woman is. So what we look at is we gather data from the audits, analytics, legal cases, and look at class action lawsuits filed against companies, look at whether these guys are defended in a class action lawsuit, and look at restatement data to find accounting restatements and in the 5 years post IPO. Nothing. There is no evidence that these women help to prevent rare disasters, right? So there's no difference in the likelihood of future litigation event, no difference in the effect across decades. Okay, maybe the institutional investors are just crazy. It's a market efficiency story, right? They jump in, buy shares, realize they get excited, and then the price starts falling. So maybe this is disappearing, right? Let's see what happens. We look at buy and hold abnormal returns, 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, no difference. Reverse into post is exactly the same. So everything is happening at the announcement day. You make an announcement, the firm goes public, and boom, the share price goes up. Afterward, nothing. It's exactly the same cash flows, exactly the same abnormal returns going forward. Okay. Another possibility is the underpricing happens because women don't know how to bargain. Right? Maybe. So what does that mean? Women don't know how to bargain. Well, the key is, as an investment bank, I want to cater not to the firm, but to my institutional investors. Why? Because I keep dealing with them every day. But the firms, I only deal with once in a blue moon when they issue shares or something like that. So most of the time, if I want to make somebody happy, I want to make my institutional investors happy. So if I have women on the board, they don't know that it's being underpriced. So you can shut the price too low deliberately so as to take advantage of the women. Now, that's not what we find either. So if you look at the supply of male directors and supply of female directors, the supply of female directors actually gone up dramatically from 2010 to 2018. And more interesting, if you look at the relative length of, the age of women to men, the bio length of women to men, the number of skills of women to men, all of this is thinking about how experienced these directors are. None of them is significant. Right? It's not that women are worse bargainers than men. Okay, so maybe this is greenwashing. I know an IPO is going to happen. I just grab a woman and stick her on the board strategically. It's just to increase the thing. Is really the women are not contributing anything. Now, so what we do is we look at directors' biographies in the IPO prospectus to look at when the women are appointed to the board. Turns out the average male director has served on the board director for 3.7 years. The female director is for 3.36 years. Difference, not significant. Maybe firms adjust the board composition to be less diverse in the years that follow the IPO. Right? The answer is again, no. If you have 93% of the people who have a gender diverse board, continue to have a woman on the board. And 90% continue to have at least one woman on the board across the second post-IPOs, either a proxy statement. They do not hire the women just because they want to do IPO. You don't hire the women just after they do an IPO. In contrast, the 80%, only 80% of the companies who did not have a woman on the board continue not to have a woman on the board in the second post-IPO proxy statement. So overall, to conclude, we document a strong gender diversity effect in the level of IPO underpricing for US firms over the past decade. IPOs with at least one woman on the board are significantly more underpriced than IPOs with all male firms. What we have shown is It's not a cash flow effect. They're not creating value because of changes in cash flow. The cash flows are exactly the same. The level of exposure to rare disasters is exactly the same. Everything seems exactly the same. That means, in other words, what the institutional investors are doing is they have excess demand for these shares. The investment bank doesn't understand that there is this excess demand, so they underprice the shares too much. But some of them learn over time. So in other words, valuation models used by investment banks do not incorporate the demand for gender diversity. In other words, they assume that the cost of capital is too high. It should be lower because these people are willing to pay money for higher amounts of money for the same shares of the company, but we don't see that. So, but our conclusion is gender diversity increases firm value because it reduces the cost of capital for these firms. It's consistent with research in asset pricing that shows that values affect return. So Pastor Stambaugh and Taylor assume that the realized return is in fact equal to the expected return. So the return over a long period of time is the cost of equity. That's not true in our case, right? It's a one-day effect. It's not really, so what you have is on that day of the IPO, that's a price, the cost of capital you set is way too high. It's not the long term you're looking at. It's a short term for one day. That's what is happening over here. And so we're directly looking at the difference in firm value rate diversity. And we're showing this difference is completely unrelated to profitability and other firm characteristics. So it's a pretty strong case for the argument that diversity lowers the cost of capital. Overall, I think the policy implications are also quite strong, right? Over the past decade, a huge number of institutional investors and firms have placed a lot of emphasis on stakeholder value maximization, on diversity, and other CSR-related topics. This is becoming increasingly important in research as well as in the real world. So we are saying this seems to matter in corporate financing because institutional investors believe it's important. So in other words, if you want to take companies public, if you want to raise money, you have to take into account stakeholder value in addition to just shareholder value. So if you don't do this, maybe you're just not able to go public. You're not going to be receiving any external financing necessary for future growth. This is also a factor that's likely to be important when things about things like climate finance. If I want to drill for oil for now, for example, where do I raise money from? A lot of banks will say, I'm not going to give you any money anymore. Right? So how do you actually say drill for oil if you can't raise financing? So from that perspective, value-related factors related to the cost of capital actually are just as important as cash flow consequences. And that is where I'm going to stop with this paper. So it's about an hour.
Not yet, actually. Do you want to wrap up your material, Professor? And go
Sorry?
to the next session? Do you want to wrap up?
Yeah.
Or yes, okay. Okay. Thank you very much, Professor Raga Fendaro from the University of Cambridge for addressing this topic and giving us such an outstanding presentation and enrich our insight and knowledge. For me, this topic is so interesting because I'm a woman and right now, so many women have good achievement in social, economic, cultural, and political. But Professor Rao, ladies and gentlemen, before we move to the question and answer session, we will see the company profile video of Samuel Asset Management. Okay, Samuel Asset Management is an asset management company founded in 1997. Samuel Asset Management provides a complete range of asset management services for domestic and international investors. And our webinar today was sponsored by Samuel Asset Management. Thank you for all support. If you are interested to know more products of Samuel Asset Management, you can search them in their apps on Google Play Store. Okay, now let's move to a long-awaited session. What is that? Yes, question and answer session. If you want to ask any question, please raise your hand and directly ask to the speaker. And don't forget to mention your name and your institution. Okay, well, ladies and gentlemen, we have already some participants who raised their hands. Okay, the first is coming from Mr. Badru Bazat Olayemi. Okay, thank you, brother. You spotlight. Okay, Mr. Badru, you can pose your question directly to the speaker.
Okay, thank you very much. Yeah, good evening to Prof. My name is Badru Basit. I'm from University of Utara, Malaysia. I sincerely appreciate your detailed presentation and your research. Actually, my area is also more on IPO, which I so much interested in carrying out some further research on it. Based on your presentation, I have some couple of questions which need some clarity. First, I want to know the regression method you use, whether it is just simple multiple regression, which is OLS, ordinary least square, or I don't know, or whether it is in panel form. So I'm not clear about that because when I look at the analysis, I'm somehow confused whether you use panel or whether you use OLS. Then step two, the second question is for your financial variables, are they post-IPO variables or pre-IPO variables? Because I believe your gender variables should be pre-IPO variables. So I want to also have some understanding on that. Then the third question is, I'm not clear how you determine the money left on the table. Of course, the underpricing is clear to me, but I don't really know how you determine the money left on the table when you run the regression. Then, looking at your results, you will discover that because when I look at the results, I noticed that the gender diversity has a positive impact on your underpricing. So the question is, underpricing itself, is it to the advantage of the company or to the advantage of the investor? If underpricing is to the advantage of the investor, then should we expect a positive or a negative? So if it is to the company, should we expect a positive or a negative? Because if we are saying that having female directors on board should be a kind of a signal of a company's quality. So I was thinking that the regression results should be negative. But when I look at it, the regression result was positive. And when you want to conclude, you concluded that your conclusion again, you said gender diversity reduced the level of underpricing. So I'm quite confused based on the conclusion and also based on the sign of the regression result was. Then if you also look at I don't understand how you also determine your structural break test. So that is also not clear to me. So which I also want you to clarify more on that. Then the aspect of there is a particular portion of your slide where you also talk about the women bargain. Women do not know how to bargain. But practically, if we look at it, let's look at a practical example whereby when we send the women to the market, they know how to, or maybe they go for shopping, they even know how to bargain better than we, the men. So I want to know how do you argue this out in your analysis? So these are some of the, I think maybe by the time you answer some of these questions, then I'll be able to know, because I still have some other further questions which I also want to ask. Thank you very much.
Okay. Okay. Professor Rahul Federal, are you ready?
Yeah, thank you for your
Okay,
questions.
please.
I mean, there are a lot of questions, and I'm not sure I remember all the questions. But let me start, and you keep I'll keep answering the questions, and please remind me when if I forget which question. Next one, starting with your first question on, I guess when is the data, whether it's an OLS? Yes, it is, but it's a panel data set. So what you have is every year you have all the firm values, you have the level of underpricing, you regress that over time and use diverse and post as in part of the panel. You have to have a panel data set. It's not a cross-sectional stacked regression. Second thing, you asked about where the data was collected. Pre-IPO, you're right, they don't file financial statements, but they file financial statements at the IPO date, right after that as well. So this is the closest date to going public where they file the financial statement, and those are the control variables we use there. Third question, I think you asked for how do you calculate money left on the table. And so the money left on the table is very simple. It is the difference. So the filing price is, say, $100. The company ends up at the end of the day at $120. That means they could have priced it at $120. They left $20 on the table per share. But they issued 1,000 shares, so 20,000 shares, so $20,000 is the amount of money left on the table. Right? And underpricing is bad for the company. That means, in other words, if you're a founding investor, if you're a pre-IPO investor, say if you're a founder of the company, you do not want to leave money on the table. So what we find is if you're a gender diverse board, there is a greater amount of underpricing, not a smaller amount of underpricing. The positive relationship underpricing and gender diversity is the core of our result. The investment bank could have priced the shares higher and not left money on the table. But because they didn't appreciate the fact that there was a woman on the board, they priced the shares too low. That's essentially the core of our result. Right? So I think those are your first 4 questions. If you can remind me of your next one, that would be really good.
Okay. Isn't it? Okay, Mr. Badu, are you satisfied with the answer? Hello. If okay, I will next to the next participants. Okay, is it okay to move to the next participants? Okay, I think.
Well, let's go to Helena. She's quite there.
Okay. The second raised hand is from Mr. Suherman, actually.
Okay, thank you, Mrs. Silvana. Yeah, very good presentation, Prof. Ragu. I have 2 questions. My first question is about the choice of measure of gender diversity. Yeah. If I'm not mistaken, you employ a dummy variable to measure the gender diversity. To my knowledge, there are at least 5 measures of gender diversity, like proportion and also the number and so on. So can you explain why you employ only one measure of gender diversity? instead
we
of
actually use
4 or
two.
maybe 5.
We use
Two, okay.
two.
And number 2, is
It's
it
a
possible
fraction of
that
female.
okay, is it possible that gender diversity influence the long run performance of IPO? That's it. Thank you.
Okay.
Well, number one, the answer to your first question is we use both fraction females as well as a gender diverse dummy. But it doesn't really make any difference because an average board size, you've got 8 people, right? Is the typical size of the board. You're not going to have 4 women on the board. I mean, typically you have 1 woman on the board and that's it. So the fraction female and the number of women on the board is usually very highly correlated. It's not really, you don't typically have 3 or 4 women. I mean, it's not significant. So it's not a big deal to have that as our main variable. But we find the same result with fraction female. Second thing, long-term performance, no relationship either. I didn't mention it in the paper, but we go up to 2 years after the IPO. There's no difference in long-run excess performance.
Okay, thank you.
Okay. Okay. Next participant who raised hand is from Mrs. Herlina Yokaroida. Yeah, can you spotlight?
Still mute. Okay.
Still unmute? Okay.
Okay. Hi, Professor Rao. Professor Rao, I did research about the gender diversity as well when I ran for the family firm research in Indonesia, and my finding is exactly similar what you got. I mean that no differences or no impact the gender diversity in family firm, because basically I tried to test and how the old boys club can be break by putting more women. My question is it possible that your result is because of the regulation driven? Because in Indonesia, it's voluntary diversity initiative and not mandatory, but we are a voluntary. So no mandatory for a listed company to have a proportion of our gender diversity in Indonesia. We start in OJK in 2014, I think. It's about board independent must be 30% of board composition must be 30% of board independent. And I tried to test it for the family female in board or board independent. That's the same result, that no implication or no effect on firm performance during, I think it's about 10 or 9 years. So do you think, I was wondering, that regulation driven this kind of involvement, because your result is quite interesting. Thank you, Prof. Rao.
Well, thank you for your question. I don't, the thing in America, all our IPOs are US IPOs, right? There's no regulation in the US. There are no voluntary diversity initiatives in the US. I mean, there's an increasing level of awareness that you should have a woman on the board, but that's popular press, that's arguments written in there. But apart from California, nobody imposed diversity initiatives. And besides, even in California and Norway, were the 2 major countries where they've studied mandatory initiatives, people have found that, conflicting evidence. So the regulation, I really doesn't work in our case because there's nothing in the US which is driven by regulation.
Okay, thank you.
Okay, thank you. Okay, the next raised hand is from Miss Salina Tantri. Okay. Okay, you can pose your question directly to the speaker.
Thank you very much, Mrs. Silvana. My name is Mitsalina Tandri, and I'm very blessed to be here because I'm very interested in this topic. And I have 2 questions. My first question is, to my knowledge, the characteristic of male director are more risk takers and overconfidence, while female directors are more careful, prudent, and detailed in making a merger and acquisition decision. But in Indonesia, especially in building construction industry, there's no female directors. Can you giving me advice. How do I write my discussion in my dissertation, please? Thank you. And my second question is, how was the impact of female director on IPO long-run performance in your country after COVID-19? Thank you very much, Prof. Raga.
Okay, well, for your first question, it's you in the at least in the U.S. There is absolutely. Let me put it this way. It's yes, you could be right that female directors are more careful, the more risk averse. Everything is fine. The point is it has to show up somewhere, right? I mean, so if you look, for example, at it doesn't show up in the cash flows. There's no superior operating performance. It doesn't show up in rare disasters. It doesn't show up in bargaining ability. So where does it show up? We don't have an answer. But that's why we say everything is driven because they're underpricing on day zero, which means it's a cost of capital answer, not a cash flow answer. There's nothing saying that women are not more careful, but it's just not showing up in the data. Right? So that, I think, is the answer to the first one. The second one is on, I think we said, what is the impact of female directors on IP? I don't know because we haven't looked at that in our paper, but it's an interesting question to investigate. I don't know if there is. The key question is always going to be how many women are actually there who can make a difference, right? I mean, the board of directors is not as important as the CEO. A female CEO is important, right? Because they make the decisions. But a board is just people who sit around a table, listen to what the CEO says, and say, okay, this is true or this is false, something like that. They generally do not overrule the CEO. Right? So that's why finding an effect itself is kind of interesting because you don't expect to find that much of an effect. I have a paper that looks at gender diversity in India and looks at whether interlocked boards create innovation, but that is was published in the Journal of Corporate Finance. It's sort of related to your topic which you're talking about, but it's not directly related to gender diversity. It's more with the interlocking effect that's important.
Okay, thank you, Prof. Raga.
Okay. Okay, there's other raise hand. Okay.
Okay, yeah, thank you.
Say something.
Can I talk? Can I ask my question?
Mr. Badru again.
Yes.
I'm sorry. We have another.
Okay.
Okay. From Mrs. Diana Riana. Okay. You can pose your question directly to the speaker. You can unmute. Yes. Yes, please.
Yeah. Thank you, Ms. Savannah, for the time. Let me introduce myself. My name is Diana from ONJ. Regarding the tema, Prof. Raghavendra, my question, is there any research, another research, which based on a survey from the investor opinion about the diversity and the IPO underpricing? If yes, the research based on the survey, maybe you can share the result.
So research on, did you say IPO underpricing?
Yeah, based on the investor opinion, is this diversity and IPO underpricing is determinant the decision or not based on the survey? Maybe you can, another research based on the survey. And the second, I have a plan and I to do the same research in Indonesia, but I'm afraid the research maybe is different with the your research. Maybe it's not significant because it's the government regulation is not mandatory for the diversity. So maybe you can suggest the idea for my next research. Thank you.
Okay, well, I think the papers which you want to look at are more in the range of diversity initiatives in other countries. So, you know, papers are the most important papers, as I say, are the ones in Norway, but there have been papers written about France, there have been papers written about other countries which have introduced diversity initiatives. And I think that's probably more closely related to your particular topic. You may want to take a look at some of those papers. I think they offer different types of experiments which you can take a look at, which might help you with your research.
Mm-hmm. Okay, is it okay, Miss Tiara? Okay, now we go to the next, yeah. Mrs. Yi.K. Feliana Ubaya, do you want to speak directly to the speakers? Mrs. Yi.K. Feliana Ubaya? Okay, okay. Do you want to speak directly? Okay, we still have 8 minutes left for question and answer session. So waiting for another participants, I have a question for you, Professor Raghavendra. In Indonesia, on average, the proportion of women's board is much smaller than men. Is it relevant to test the existence of board diversity in such condition? If relevant, what is the right measurement so that statistically it can be seen its role in underpricing IPOs? That's my question.
So in Indonesia is the question?
Yes, yes, from Indonesia.
Well, I'm not that sure what to say because the key is you have to understand the institutional features of the country before you can actually form a hypothesis, right? So I'm not sure what the regulations are in Indonesia. I'm not sure whether there are actually any initiatives by the government. I'll have to look at Indonesia in particular in order to answer that question. I really am not that familiar with the country. Right? I mean, I know I've been to Indonesia and I know the country, but I don't know anything about the regulations for diversity. This is what the U.S. data. Right?
Mm-hmm.
So I'm not very sure what I can answer in that case.
Okay. Thank you for your explanation. And after that, there is Mr. Anka Utama. Okay.
Okay, thank you, Ms. Silvana, for your time for me. Good evening, Mr. Rao. I want to ask something about how many studies about found that gender diversity as portion of women on boards have significant positive effectively to the company or in the parliament in a country, especially maybe in USA. Perhaps you can make comparison by the Indonesian and the USA about the diversity, positive impact for gender diversity. Thank you, Mr. Rao.
I can't really make much of a comparison with Indonesia because I have to, you know, I have to actually look at the country's regulations before I actually make a comparison. I can talk about the US because I've actually done the study in there. Yeah. But how this applies elsewhere in the world, I don't know. I do have papers on gender diversity, for example, in China, but that is also not comparable to Indonesia. So at the best, I would probably say I would have to look at the actual situation on the ground before I can draw those comparisons, right? I mean, it seems to be a question which is outside my area of expertise at the moment.
That's it?
If we have time for just one more question, I have to head off.
Okay. Okay, we still have 5 minutes left. Miss Yi Ki Feliana Ubaya, do you want to speak directly to the speakers? Okay.
Okay.
Yes, clear enough.
Okay. Thank you for the opportunity. Prof. Rao, it's interesting research and you do already a comprehensive study, I think. Based on your Prof. Rao research, what is your argument for the recent gender diversity increase the underpricing? Because I listen your presentation, all of your variables are insignificant to explain that. So maybe you will share your prediction. What is the reason? If there is gender diversity, it will influence positively to the underpricing. That's my question. Thank you.
Well, all I'm saying in the paper is that underpricing is bad. Like, you don't want your IPO to be underpriced if you're the founder, because you're leaving money on the table. So what you want to do is reduce that level of underpricing. Now it turns out what we are saying is, when you have a gender diverse board, if you have a woman on your board, you end up being underpriced more than if you do not have a woman on the board. And that, we say, is actually bad for the firm, because the key is there are two parts to underpricing. One is the investment bank, which is setting the initial offer price, and the second is the price bid up in the market on day one. That's efficient. The second price stays. The moment the price shares are trading on the open market, beyond that, there is no gender diverse effect. It all happens on day zero. That means on the day the company goes public, the investment bank hasn't understood the value of women. So they're putting the share price too low. They're issuing the shares at too low a price. So there's a lot of underpricing. And that, once the shares are trading in the open market, there's no effect beyond that. Cash flows don't change, long-term returns don't change, short-term returns don't change. Nothing changes after day zero. So that's the basic story.
Okay, so it's not so the diversity. We cannot explain more why the diversity influence.
No, we do say that. We say the diversity happens because you have a bunch of institutional investors who want to buy shares of companies with women on their boards. Okay. This is a societal change. From 2009 to 2010, an increasing number of people have been talking about gender diversity. They've been trying to buy shares of companies with gender diversity. And this is a social effect. If society believes it's important to have women on the board, they will pay more for the shares of companies with women on the board. And that's what we find. It's all driven by institutional demand. Okay. It's not retail demand. It's not individual. As a person, I may or may not care about women on the board. I don't even know the identity of people on the board. But institutions know this, and institutions are the ones who are buying shares of their companies. So this is an effect driven by institutional investors the demand is high for these shares, and underwriters do not understand it.
Okay, thank you.
Okay, we still have one more question. It's coming from Mr. Supriyadi.
That to be a short question because it's
one question. Yes. Okay, operator, can you spotlight Mr. Irzan Supriyadi? Mr. Irzan Supriyadi?
Hello.
Okay. Hello.
Thank you. Sorry, it's very long to unmute my phone.
No problem.
Thank you for the explanation, Mr. Prof. Rajab. Sorry, I mean wrong spell. What kind of diversity you mean at that term? It's about the couple of the gender in one of the company, or the variance of management and the treatment and whatever the variable of diversity you mean at that your research. Thanks a lot.
I'm not sure I understood the question.
Okay, no problem. No problem, yeah, Mr. Izan. Because I think time is up, yeah, for a question and answer session now. Okay.
That's probably. Sorry, I didn't understand your question, Izan.
Yes. Okay, I think this is the end of the question and answer session. Thank you, Professor Rob, for the very insightful topics and interactive talk with our participants today. And before we end our session, would you mind giving us anniversary greetings? As our beloved Faculty of Academics Universitas Negeri Jakarta is celebrating a sweet 17th anniversary, and we wish that we become a reputable faculty that produces human resources with a global perspective and characters. Please, Professor.
Well, yeah, that's really creditable. Congratulations. Happy 17th anniversary for the Faculty of Economics, State University of Jakarta. So I think that's very creditable. And best of luck.
Okay. Thanks, Professor Rob, for the best wishes for our faculty anniversary. Ladies and gentlemen, we finally come to the end of this webinar session. And before I close this webinar, I would like to take the conclusion from the what speaker has presented. Conclusion number 1, a gender diversity effect in the level of underpricing for US IPOs over the past decade. IPOs with at least one woman on the board are significantly more underpriced than IPOs with all male board. The results are consistent with the research in asset pricing that shows that values affect return. The advantage of our IPO setting is that we directly observe the difference in firm value related to diversity. We then show that this difference is unrelated to profitability or other firm characteristics, allowing us to make a stronger case for the argument that diversity lowers the cost of capital. The results are economically significant over the last decades. Firms with gender diverse board experience a 9% point larger level of underpricing, and they leave on average $26 million more on table. Okay, thank you very much, Professor Rob, for your insightful presentation. Dear participants, give applause to our speaker.
Thank you, guys. I appreciate it very much.
Okay, ladies and gentlemen, it was my pleasure to be your moderator today, and I apologize for any inconvenience, and I will give the stage back to Master Ceremony. Please, Ms. Titis.
Well, thank you very much, Professor Raghavendra Rao, for your insightful presentation, and also thanks to Mrs. Silvana Shah for moderating this event. Before we end this seminar, I remind you to fill in the attendance confirmation form on the link shared in the chat box, because we will send you the e-certificate based on the attendance list, and we will deliver it for a maximum 2 weeks from this event. And now we will take a picture together. I need help from the operator, maybe Miss Nur.
Miss Titis.
Okay, dear participants, please please activate your camera, turn on your camera so we can take the picture together. Okay, Miss Nur, please give us a cue.
Okay.
1, 2, 3, okay?
Well, ladies and gentlemen, I will take some picture and start by slides, first slides. So 1, 2, 3. Okay, for the next slide, 1, 2, 3. Okay, for the last slide, 1, 2, 3. Okay, thank you, Ms. Titis. Thank you, participants.
Okay, thank you very much for your help. And ladies and gentlemen, now we finally come to the end of the seminar. Again, I'd like to thank the speaker for the insightful, interesting, and wonderful presentation today, and all the participants for the very active participation. I also thanks to the committees who have organized this wonderful event. Thanks to all the co-organizer, Universitas Brawijaya and Universitas Katolik Widya Mandala Surabaya. Also thanks to our sponsor, Samuel Asset Management, and for you all the participants. With the end of the day's seminar, it's also closing the series of International Seminar of Economic Expo 2022. Thank you very much. It was a pleasure to be your MC today, and I apologize for any inconvenience. Good afternoon, and wassalamualaikum warahmatullahi wabarakatuh.
Thank you
See
so
you
much,
on the
Ragu.
next event. Thank you, Professor
Thanks, guys.
Ragu.
Thank you.
Thank you.
Thank you, Professor Rao.
Bye.
Bye. See you. Keep healthy for you. Okay.